So no matter what happens in the economy, what happens with tariffs, what the next sexy investment is, or the next things the government's going to put money into, people need housing. And when there is a housing shortage, over the long term, you will have growth of, like you said, about 1% inflation adjusted in natural appreciation that has nothing to do with, forced appreciation or flipping the house and creating, growth. And so you just have a lot more stability in an asset like real estate, where you know that there is going to be a demand.
All righty, folks, we're going to talk about a concept that many of today's investors really haven't had to think about. And that is the concept of what is called a lost decade. Folks, if you go back and you study history, there have been several times different asset classes have essentially gone nowhere over a 10-year period. And there's lots of chatter, lots of talk that we might be in or revisiting a lost decade. In fact, the one and only Anna Kelly brought this up a couple of times over the last year, that she thought a lost decade might be in front of us. So, Anna, you brought this to my attention first. What did you see? What are you thinking? Do you think a lost decade might be in front of us?
Yeah, I definitely do feel like we're probably going to have a lost decade. And I think we're kind of about 2 years into that, other than the stock market, which has, gone up, but it's also come down and close to correction territory, every indices and some actually in correction territory, with a lot of volatility. And so lost decade doesn't necessarily mean there aren't periods where certain assets are going to go up or down, but generally they're either an asset that's not very volatile, but just isn't growing, or they're an asset that has a lot of volatility, but evens out over the decade at basically flat, kind of where you were before. And one of the things that we saw after the GFC in 2008, 2009, actually it was backdated. The recession was called very late, backdated into late 2007, by some estimates, early 2008. But the recession itself was about a year and a half long. And what a lot of people don't realize is that a recovery period, before you really start having real growth in the economy, after a mild recession of about 10 months on average, a recovery period takes 2 to 3 years. So let's just say a little bit longer than average recession, or real economic crisis of some sort, such as COVID, or the things that we've saw now with, huge rise in inflation. Typically, that recovery period is going to be at least 3 years. But again, what we saw after the GFC, even though people say, wow, it was an amazing run and an amazing expansion, that expansion didn't really get started till about 10 years after, in about 2018. And that's when we started to see real growth that was overheating the economy. And that's when we started to see assets starting to go up in value, and probably teetering on a recession in late 2018, early 2019. Clearly manufacturing recession. Then we had COVID and it kind of skewed things. But the growth really took about a decade just to get kind of back to where we were pre-GFC. And a flat decade to me is saying, I think what we're going through economically, even whether you're technically in a recession or not, just the volatility and the changes post-COVID are so impactful across the breadth of the economy, not just hitting one sector like real estate or the stock market, but really hitting everything. After the last recovery, we kind of hit this bubble, this everything bubble. Everything then suddenly went crazy, and that bubble has clearly started to burst, and now some values are coming down. So I started to see, we're losing some of those gains. We haven't even had the maximum point of pain yet, and we're already seeing some destruction of value, like in commercial real estate, which we've talked a lot about, now starting to kind of see it in the stock market. But the pain isn't done. And what a lost decade is, Michael, is it's me basically saying, I think it's going to take more to spark a new expansion period and more growth to get us out of this ho-hum economy that we've had. And it's not going to be fast, so that typical 3-year recovery, I think, is going to take 5, 6, 7 years before you're even through the recovery, before you start to see some periods of growth. But in that latter part of the decade, let's say we have year 7, 8, 9, 10 starts to do a little better. I don't think it's going to be truly expansionary and get us back anywhere close to the highs, before we started to have all the COVID and then the inflationary crisis that, made interest rates go back up. And, I didn't just come up with this on my own. I have to be fair and give credit to where credit is due. But I started to have some of these same concerns that, wow, it took a long time to recover from the last one. And these things are not going to recover quickly because we don't have a lot of the things necessary to do that. One, the government's ability to print money to stimulate us out of the mess the way that they could before our debt was at truly crisis levels. Two, they can't truly cut interest rates to spark the next growth cycle because we have too much inflation threat in order for the Fed to do so. This is why we've been higher for longer. So those were my big concerns. But I did start listening to a lot of old guys, right? Because the guys that have been through the block, been investing longer than I've been alive, they have some wisdom to share. And when I listen to guys like Jeremy Grantham, a billionaire hedge fund manager, well-known nationwide, like Ray Dalio, like Charlie Munger, saying, Warren Buffett's right-hand man who passed away last year, saying, we think we're in an everything bubble. And we think that if you're really, really, really good at what you do, you might experience 1, 2, 3% annual growth rate. And that's barely going to keep up with inflation. Essentially, i.e., this will be a lost decade. And I think it's Jeremy Grantham that I first heard say that. But multiple very smart people who've been through these cycles before are warning that it's going to take a whole lot more to get the growth that we've seen in the past and to not expect it over the next decade. And that means we're going to have to be very wise about where we find growth and where we find value when the overall economy is not this big tailwind that's going to make everybody look like a rock star in 2 to 3 years. It's going to take a long time before everything goes way back up, especially when we're kind of at a peak everything bubble that's most likely to pop before we even get back up to where things were before then.
Yeah, I think your call, again, paying attention to the folks who've been here before is really wise advice. The everything bubble makes sense to me. Also, the lost decade is making sense to me. I saw a report today from Housing Wire that looking at the median price for active listings is, I think it was 453,000. The number is irrelevant, but what is relevant is it's basically been flat for 3 years now.
Yeah.
Right. So again, we're 3 years into this potential lost decade. And what's interesting is I told people that, I thought we'd have 5 or 6 years of flat prices because, to your point, we had 2020 and 21 and most of 22 where it was up 20%. And as somebody who has studied real estate for 50 years, 55 years now, that's not normal. You don't get, you might get 20% growth in real estate in a decade, right? Which is less than 2% compounded.
Right.
That's basically inflation plus 1%. It's okay. Right. But to get it all in 2.5 years, not normal. So it was kind of an easy call that we're going to be flat and wages will just have to slowly creep up to make this once again affordable. We're 3 years into that. So far, great call. Then I think about gold or I think about stocks and the fact that I see a lot of today's investors buying the dip. I don't know if you saw this news, but inflows to leveraged long funds here recently have hit record levels. Yeah. So what does that tell me? That tells me a whole cohort of investors have not been through a lost decade before, and they're simply buying the dip every time. Why? Because it's worked. Buying the dip
on margin. They're borrowing in order to speculate at one of the worst times possible.
Which works until it doesn't.
Instead of an investor. Right?
No doubt. It works until it doesn't work. And I fear we're going into that environment where the buy the dip is just going to stop working. If we do get into the lost decade, if we get into a lost decade, all kinds of things break, right? One of the things you should go study is the 80s. And the stock market was essentially flat for a decade. Now, I was listening to it might have been Grantham, the guys that have been around 40 to 50 years. And they're basically like, a lost decade does not mean you can't make money.
Right.
A lost decade means you don't buy the index. Yeah. You don't buy all the stocks. You have to be, it's basically becomes a stock picker's market because there will be sectors that do well, right? In the 80s, it was gold and energy. Today, it might be AI and something else. So, we've had 20 years of or ever since the GFC, we've just been told the Fed's going to bail us out. We're going to print a lot of money and interest rates are going to be zero. I don't think any of that's coming. So we're
Right.
going to have to change.
Absolutely. And that's one of the challenges, with the stock market. I know we've done a couple talks on it, and I'm not a big fan of the stock market. I mean, it's what I have my background in private banking and institutional hedge funds. But I was able to make wealth through real estate. So I still prefer real estate to make wealth when you don't have anything to start with, right? Because if you don't have anything to start with and you start borrowing to speculate and you're going to have a lost decade, you might not make as much of a return in those indices versus the interest rate you're paying on the debt in order to leverage, right? Where we had a long period of time where index funds were really the way to go. And index funds have done okay because they've been pretty heavily weighted in companies that have done well. And in the last several years, we talk about the Mag 7, even your index funds have been very heavily weighted in them. So when those Mag 7 become the Mag 4, like they kind of have with a little, a few falling in and out of that, you basically have a lot of losses to go with your big gains when the indices are very weighted. And really, it used to be that brokers, and I know because I was in private banking, would just refer you to an index fund and say, hey, you'll make 8% a year over time. Sometimes they'd say 9, depending on the year of the benchmark. But the reality is so many people and institutional investments are in these index funds that are very heavily weighted to 1 or 2 companies per sector, where if the sector overall doesn't do well, even that top 1 or 2 won't. And so this is where, Jeremy Grantham said, if you're really, really good, like you're an expert stock picker, like we have hundreds of people on staff that trade. And if you really know what you're doing with R&D, they have full R&D teams behind them to say, if it's going to be tech stocks and AI, which ones are it going to be? If it's going to be, semiconductor companies, which ones are we going to invest in? And they say the years of investing in indices and hoping it goes well are really over. If you're going to do well, you must be an expert stock picker. And I can tell you, when we've had those dips, I've bought a little bit, but I buy enough that I can lose it all. I'm not putting anything in there with speculation because that's not investing. It's hopium, right? I'm going to throw in because I think the market will go up. So all these companies must go up. If you have a lot of time, you're really young, 40 years, to play with these big corrections of the market, potential big recessions, and then wait, for a decade for them to get back to baseline before they go up, knock yourself out with money you can afford to not touch. But if you can't afford to lose it and not recover your principal back in 3, 4, 5 years, it's really stupid to invest in stocks that you don't understand. So one of the investing 101s is don't invest in what you don't understand. So if you don't understand the fundamentals, the headwinds and the tailwinds for any given sector and for particular companies and how they're positioned for risk in the future, you really have no business buying particular stocks that you know nothing about, because you've got to understand how that company's making money, how they're generating profits, what their cash reserves are, how much leverage they have, and how are they hedging for things like tariffs, right? So there's lots of companies that are generally amazing. And then suddenly when there's tariffs on things like fertilizer, that company may be like poof, their earnings are gone and then you lose everything. So I'm just not a gambler. And, with real estate as well, even though we don't know for sure, will you have blips where real estate values go down? Absolutely. Will you have blips when they come back up? Absolutely. But the thing I love about providing housing, whether it's in single family houses or whether it's in a multifamily housing project of whatever side, is that you've always got a need for housing. It's a fundamental need. So no matter what happens in the economy, what happens with tariffs, what the next sexy investment is, or the next things the government's going to put money into, people need housing. And when there is a housing shortage, over the long term, you will have growth of, like you said, about 1% inflation adjusted in natural appreciation that has nothing to do with, forced appreciation or flipping the house and creating, growth. And so you just have a lot more stability in an asset like real estate, where that there is going to be a demand where you're investing areas with a lack of supply. And the other big thing, especially, it's true of all seasons, but especially if you're going to have a lost decade, Michael, is location, location, location.
Yeah.
So you've got to know, where am I investing? Am I investing in a city and a state that is bankrupt, that has jobs leaving, that has layoffs, that has nobody moving to there? My real estate's not going to do very well. But if you look at, where are there cities where they are pro-growth, pro-business, in an environment that might have struggles to get growth, then your assets are going to do better there, because you're going to constantly have people coming in for jobs. You're going to have local governments that are basically incentivizing people and companies coming, low taxes, pro-growth, and you're going to do better there. So I think it's really important to look for, where are the pockets of opportunity, not just say it's a lost decade, so I'm out, because inflation will eat your lunch if you're just out and sitting cash. But there's lots of opportunity all the time, but it's going to be harder. And one of the things I love that you say, Michael, all the time is do the work. Like, don't wish it was better and easier, wish you were better. And you have to get better if you want to do well in a flat decade in the future. It's not going to come easy to you like it has to some in the past.
No, yeah. When I really put the pin in the lost decade, it really points to your point, do the work. Right. Like you, I like real estate versus stocks. First off, I always admit I'm a horrible stock trader. I'm too emotional, all the above. Right. It's not my thing. Right. I just know thyself. Like you, I play with money, and I do call it play with money that I can afford to go to zero. And oh, by the way, I've seen stuff go to zero before. I lost 80% in the .com crash. So I know what that feels like. But I like real estate because it is inefficient. I can learn a market. I call it a buy box, better than anybody else. If I have that discipline, I will know an opportunity when I see it. I also, in a buyer's market, which, oh, by the way, we are in more and more of the country, I can get creative. I don't have to pay cash. I don't have to get a conventional loan. I can get seller financing. I can get a seller second. I can get equity partners. I can JV. There's all of these things that, if you get good at what you do, you can create outsized value. And what I like about a lost decade for investors in real estate is there will be lots of people that get tired and give up because it's flat. A lot of people in real estate bet on appreciation, and they're going to get burned. There's going to be a lot of tired landlords. And all that means to me, Anna, is more and more opportunity. I want less demand. I want more supply, and I want more motivated sellers. Congratulations. I'm 3 for 3. I'm excited for what's coming.
Yeah, I am too. And it's something that you said that's really important, is you don't buy something because you're banking on appreciation. That's what speculating in the stocks is. It's banking on them going up. But people do that with real estate as well. And they're like, well, it's always going to go up, so I'm just going to buy an alligator, as you put it, that doesn't cash flow, because it's going to go up in value and rates will drop. And then I'll take the equity and then, just ride into the sunset. And the reality is, when you have something like a flat decade, that even 1% inflation adjusted, you may not experience that every year during that time in your portfolio. So you've got to have something that's at least paying you to own it and cash flowing at the same time. So you got to work harder. That's an example. You're not going to find every listing is going to cash flow. So you got to say, how can I make this listing cash flow? And I'll give you one quick example. I bought a single family house. I was really hard into multifamilies and vacation rentals. I was like, I'm not going to buy another single family house. Well, I changed my tune because the things changed, right? And I bought a single family house in a really nice neighborhood that normally wouldn't cash flow. But I knew that particular area was so low supply, very high incomes, and very hard to get approvals to develop new. And so I bought the property, but I made it cash flow through creative financing and interest only payments. I'm not banking on appreciation, so I don't care if I'm paying down principal. My deal on that one was the cash flow today for several years, and then appreciation's gravy on top. So you got to learn to do really good deals that are going to not put you upside down if they don't go up in value, right? Being really careful with the debt that you put on those properties. But like you, I'm very excited for opportunity. There's always pockets of pain. There's a lot of pain in real estate right now, and a lot of areas that people are afraid to go into. But if you can go into areas that people are leaving, and you can find solutions for mitigating risk and making a good profit buying when values are down, when there's high supply, when there's low demand, when there's high rates. Getting creative is what's going to get you properties that you can now hold through the flat decade, through the next expansion period, and do really, really well, and potentially create some generational wealth by going in when everybody else is afraid to do so.
Folks, at the end of the day, a lost decade simply means to me, I get the opportunity to create the deal of the decade each and every year for the next 10 years. So I'm excited. I hope you are too. Anna, where can people find you?
Great. You can find me here on your show every week and on my playlist on your channel. You can find me at social media at Anna Kelly, REI Mom. And if you're looking for real estate or wealth coaching and consulting, you can find me on my website at annakellyinvesting.com.
Thank you so much.